Good morning. You are watching daily market outlook for 28th of March 2012, prepared by Windsor Brokers. The markets steadied during the Asian session today, following yesterday's strong rally of euro and sterling that posted their fresh peaks, while current dollar weakness is now in the beginning of European session is giving some boost again to the euro and sterling, and pushing the dollar yen lower as yesterday's break above 83 was short-lived, and the pair lost ground after losing 83 support. Dollar Swiss continues its consolidation under strong support that was broken 2 days ago at 90.70 and aiming towards the lower levels, possible test of 90.00 seen in the near term. Crude oil is again under pressure after yesterday's rally above 107 level. Was again stalled at 107.70, and the fresh easing below 107, currently moving around 106, weakening the near-term structure. Gold is easing off yesterday's peak, just under $1,700 per ounce. Currently moving around the 1680 zone, with the pullback seen still corrective, as long as strong supports at 1670 hold the downside. The Asian stocks also drifted lower during the night after rallying the previous session on hopes for further stimulus from the Federal Reserve, as investors waited for more clues on the state of the U.S. economy. The European equity markets were likely to follow weaker Asian peers, as the Europe just opened, and with the financial spread betting predicting major European markets such as FTSE DAX to open down 0.2 to 0.3%. The US stocks were steady during the Asian session. From Europe, it seems that Europe appears to be making enough progress in dealing with its debt crisis that the US Central Bank probably will not need to take any more action to shield the US economy from the possibility of harmful spillover on exports or jobs. Top Federal Reserve officials said on the congressional panel yesterday. The William Dudley, the president of New York Federal Reserve Bank, said European liquidity concerns were easing, and the funding costs for governments throughout Europe had declined. He said the U.S. authorities were watching closely and defended the decision to provide dollar swap lines to Europe as having been in the best interest of the United States. His comments were quite similar to congressional testimony a week earlier by Fed Chairman Ben Bernanke, who said financial stresses in Europe had eased in recent months, and that U.S. bank exposure to potential losses from credit default swaps they sold to protect against possible European sovereign debt default were manageable. Dudley described the U.S. economy as growing moderately, and added caution that some strains persist in the financial market and they continue to pose significant downside risk to the outlook. He also noted that dollar swaps the U.S. Central Bank had set up for European financial institutions, together with the actions by European Central Bank to increase liquidity, had helped add stability to Europe's banking system. Dudley didn't entirely rule out more Fed actions if necessary to counter Europe's downturn, but stressed that any such action would be for the United States benefit. The European officials continue to discuss how to build up a credible funding firewall to further reassure markets that a debt crisis that has severely affected some countries like Greece will not be permitted to spread to Central Europe. From pardon, today's events, we have the German preliminary CPI that is due during the day, as several regions will release their CPIs in the different times. Will be following this, and most of you will be informed. Whoever is connected to Windsor as a platform, you will have the data as soon as they are released. From Eurozone at 8 o'clock GMT M3 money supply, no change, 2.5% is today's forecast, as the same as previous release. Also at the same time, Eurozone private loans are expected to grow to 1.3% compared to 1.1% of the previous month. Half an hour later at 8:30 GMT's UK current account, that today's forecast shows expectations for a narrowing of the trade gap to minus 8.5 billion pounds compared to minus 15.2 billion pounds of the previous month. At the same time as UK's final quarterly GDP for final quarterly GDP, no changes are expected. The negative figure at minus 0.2 is seen for today, the same as previous quarter's release. The UK's revised business investment quarterly release is forecasted for slight improvement. Minus 5.4% is today's consensus versus minus 5.6 of the previous month. From US core durable goods orders monthly release due at 12:30 GMT. Great improvement expected today, 1.6 increase of the durable goods orders compared to negative release of the previous month, minus 3.0, while durable goods orders are expected to grow by 3%, much better than the previous month, minus 3.7. And final release is the US weekly crude inventories that are due at 14:30 GMT, and compared to the last week's draw of 1.2 million barrels, today's forecast shows build of 2.8 million barrels. That is basically now affecting the current oil price, as it's heading lower, meaning that supply is good enough and the consumption is reduced. Now quick look at the markets to see the latest movements of majors and commodities and the outlook for today. Starting with euro, yesterday's rally that peaked at 133.84 and just ahead of 134 psychological barrier, and also ahead of our key barrier at 134.85, double top of 24th and 29th of February, had found support at 133.10 zone, where the 55 days exponential moving average contained dips just ahead of a more significant and strong support at 132.80 zone, previous range ceiling, and this is basically the first strong level that should contain any further reversal in order to keep the short-term positive structure of 130.00 15th of March low intact. Below this, next support is 132.37, the main bull trend line, ahead of 131.91, and only break below these two levels actually would weaken the structure. However, the pair has so far found good ground above 133, and currently heading higher after consolidation during the overnight session above 55 days exponential moving average, and currently regaining levels at basically the first mild barrier at 133.40.50 zone, above which to possibly focus 133.84 yesterday's high and 134.00 as psychological barrier. The hourly studies are still I would say neutral at this point, but holding still on the border to the negative territory, and we need to see the break above 133.50, 133.60 in order to improve studies already started pointing higher, but we need some more gains in order to confirm. 4-hour structure is still positive. Studies started briefly to point higher with the 20 days exponential moving average at 133.00. Now underpinning started pointing higher and underpinning the current positive, near-term positive structure. Situation on the daily is still positive. We see some loss of bullish momentum at this point. We need to see the break above 133.84, 134.00 in order to improve the structure and resume the short-term rally of 130.00 and possibly for possible test of our key barrier 134.85 double top. The sterling yesterday's strong rally that cleared the barriers at 159.22 and the previous key barrier at 159.91, peak of 29th of February. Extended gains briefly above this level to test 160 psychological barrier. That was the high of yesterday. Ahead of easing, initially the dips were contained at 159.40, which was yesterday's range, consolidation range floor. However, this morning's action has seen extension lower to 159.28 so far, where is the 55 days exponential moving average, and just ahead of more significant support. First comes at 159.22 and 159.00. This is actually the strong support, previous range ceiling, and holding above this would keep the immediate structure intact for a possible fresh attack at 160.00, break of which to open 160.90, 161, and the possible extension towards highs of 2011 at 161.29 and 161.64. The daily structure has improved after a sustained break above 200 days moving average that was capping the upside for quite a long period of time, and several false breaks occurred before the latest one. So we need to see the pair holding above 200 days moving average in order to resume the recent short-term rally of 156.00 low of 12th of March, and also break above 160s to signal break out of the current range that lasts from the beginning of February 2012. So basically nearly 2 months of range between 160 and 156, break of which is to open way for a stronger action higher as a part of the longer term rally of beginning of January 2012, mid-January 2012 low at 152.33 that got congested within 160 and 156 level. Back to the near-term studies, outlook on the 4-hour chart is now seems to be losing traction, while the hourly studies are have lost momentum, and the MACD is attempting to break under the center line. That might signal a deeper reversal. Just to repeat, the strong support at 159.20, 159.00 now comes in focus, while only break below 158.60, whereas 55 days moving average on 4-hour chart, and a higher low of 26th of March at 158.00 would significantly weaken the structure and keep the upside out of reach in favor of a deeper reversal, with the next stronger level at 157.69, low of 22nd of March 2012. The dollar-yen initial corrective attempt of 81.95, low of last Friday, is now losing, running out of steam, as the pair pairs yesterday break above 83.00. That was initial resistance. Actually, it was a near-term break point. Failed to hold gains higher. 83.38 was seen ahead of current easing. Break below 83.00 has weakened the near-term structure, as the initial support at 82.60 now comes under pressure. 82.64 seen so far, and this is our actually a key near-term level to watch. If we see the break below 82.60, it will increase possibilities of further easing. Interim support is 82.29, low of last intraday low of last Friday, and then the key hurdles at 81.96, 81.85 break point, that loss of which actually is seen of further easing lower. Before this, there is a trend line, main trend line support at 82.60, which is equivalent to the lows of yesterday. Pardon. The lows of yesterday at 82.63 and on Monday at 82.59. So we have quite strong support at 82.60, and the break of this would signal possible extension and retest of previous low at 81.95 and the break point at 81.95, 81.85 zone, and the break here to open way for a stronger correction of the past 2 months rally from 76.00 to 84.17, and to open 81 zone, which marks also 38.2% Fibonacci retracement of 76 to 84.17 rally. On the upside, 83 now acts as an initial resistance, while the regain of yesterday's high at 83.38 and the previous consolidation ceiling at 83.40-50 zone is required to improve the near-term structure and avert immediate downside risk for possible revisit of levels at 84 and peaks at 84.08 at 84.17. The dollar Swiss holds its negative structure, especially after losing its key short-term support at 90.70, lows of 8th of March and 21st of March with the latest price action lower, denting also our initial support at 90.20 that was briefly taken out yesterday by hitting 90.15, and currently the pair is in the narrow range sideways movements, with the upside being capped at 90.50 zone, 55 days exponential moving average that is keeping the corrective attempts limited, and still holding under the first strong support, previous strong resistance, previous strong support at 90.70 zone. Only break of this level would ease the current bear pressure and open way for stronger correction. However, only break above 91.35, last Monday's high, would improve, would give some more significant results and would improve the near-term structure for possible further extension higher. Otherwise, downside remains vulnerable, and the loss of 90.15 opens our next target psychological support at 90.00, ahead of a key short-term level at 89.30, double bottom of 24th and 29th of February 2012, below which to open way for a extension of the broader downtrend of 2012's high at 95, 93 posted at the beginning of January, and expose next strong dynamic support at 88.37 currently, the 200 days moving average. Gold is in recovery, in the corrective mode currently after yesterday's past 2 days actually strong rally of last week's low at 16.28 that peaked yesterday at close to 1700 level. Our next psychological support, psychological resistance, as the price action broke above initial Fibonacci resistance at 1690, that marks 38.2% Fibonacci retracement of the latest down move from peak of 29th of February at 1790 down to 1628 low of 22nd of March 2012. So far the corrective action is seen contained by 20 days exponential moving average on the 4-hour chart, and ideally and holding above the next strong support at approximately 1665, 1670 zone, with the 1673 low seen so far. Ideally, reversal at this point would keep the near-term positive structure in play for possible retest of renewed attempt at 1700, above which next Fibonacci level is 50% at 1709, and the 1716 more significant lower top of 12th of March, and the next strong barrier at 1725-28 1st of March high, and the consolidation range ceiling, as well as 61.8% retracement. On the downside, loss of 1670 zone would be risky for further easing, and possibly to sideline the current bulls, and likely to open way for return towards 1634 and 1628 recent lows. The hourly hourly studies are still negative, and we need to see more stronger extension higher to regain levels close to 1700 in order to improve the current structure. Study started pointing lower. Initially, it's attempting through 20 days hourly exponential moving average at 1681, which is the first obstacle ahead of 1686 zone. That is our next level ahead of yesterday's peak at 1697. On the daily, studies have slightly improved as the pair attempted actually briefly broke above 200, lost 200 days moving average, but so far failed to sustain gains. We need to see the break above this level, and today's close higher that will keep the near-term positive structure of 1628 in play for possible further extension higher to the levels 1716 and 1725. Also before this at 1702 there is 55 days simple moving average seen on the daily chart. A brief look at the oil. As shown on daily chart, it remains sideways with the neutral studies. At this point, actually, the studies are moving sideways also, so no action seen on the past, I would say, 3 weeks or so, as the broader picture is still in the positive tone of 74.94 low of October 2011 with trend line support at 104.70 along with the previous lows at 104.50.30, and this is the major support in the short term, and only break of these levels would give the direction towards the downside and open the next strong support zone, previous range ceiling at 103.70 zone, the range of November 2011 until January 2012. On the upside, from the other side, break above 108, 109 levels is to define the fresh trend higher, and open levels at 109.92 and 110.53 recent peaks. On the near-term outlook, studies on the hourly chart are turning negative now. Already broke below their midlines, and crossed below 20 and 55 days exponential moving average, with 20 days now attempting to cross below 55 days one, signaling a possible fresh further weakness ahead. Immediate support, static support is 106.18, low of 26 of March, ahead of more significant levels at 105.15, and the key support and the range floor at 104.50.30 and 104.70. We have the main bull trend line. 4-hour situation is also losing traction after the price being unable to hold the gains above $107 per barrel, and currently both pointing lower, looking for test of previously mentioned levels 106.18 and the possible extension lower. just important also to say that the situation with Iran and the other oil suppliers, as mentioned in our yesterday's session, is still keeping the oil prices well supported, as are trying to show that there is oil shortages, freshly imposed oil sanctions on Iran from US, Eurozone, and a number of Asian countries, which are basically the main consumers of oil. Iranian oil is putting boosting additionally the oil price. However, the comments from Saudi oil minister saying that there is enough production and Saudi Arabia is ready to put the full capacity their oil production to boost it to the maximum in case of any shortage, but so far there has been no shortage in the oil supply worldwide, despite current problems with Iran, and Libya is back, and there were some problems in Sudan. We have to closely watch the development in the current situation in the Middle East, especially unrest in Syria, and that is directly related to Iran. That will give some more clues about the future oil price. Have a nice day.